What are the arguments for and against estate tax reform? Have you ever wondered how changes in estate tax laws could impact your financial future? Today, we are discussing the arguments for and against estate tax reform, particularly in the context of estate planning and federal estate tax. First, let's look at the arguments in favor of estate tax reform. One key point is protecting family businesses and farms. Many supporters believe that high estate taxes can force heirs to sell these businesses or farms just to pay tax bills. This can disrupt local economies and harm the continuity of these family enterprises. By raising exemption limits or providing relief, families can keep their businesses intact. Another argument is that estate taxes may discourage savings and investment. Some people feel penalized for accumulating wealth, which can lead to less capital formation. Reforming the estate tax could ease this burden and promote economic growth by encouraging individuals to save and invest more. Additionally, simplification and permanency are also significant points. Recent reforms have made higher exemption amounts permanent and indexed for inflation. This stability helps individuals and their advisors plan more effectively, reducing uncertainty in estate planning. Now, let's consider the arguments against estate tax reform. One major concern is revenue loss and wealth inequality. Critics argue that raising exemption amounts or abolishing the estate tax could significantly reduce federal revenue. This could allow wealthy families to transfer large fortunes tax-free, which might worsen wealth inequality in society. Another point is about tax avoidance on unrealized gains. The estate tax captures these gains at death, preventing heirs from avoiding capital gains taxes. If exemptions are expanded or the tax is eliminated, it could create a loophole where heirs inherit assets without paying taxes on their appreciation. Lastly, the estate tax is considered one of the most progressive federal taxes, targeting the wealthiest individuals. Removing or weakening it could shift the tax burden away from those who can afford to pay, increasing reliance on less progressive taxes. In practical terms, the current high exemption levels mean many estates are not subject to federal estate tax. However, this could change if exemptions are lowered in future reforms. Estate planning strategies should consider potential changes, including the use of trusts, lifetime gifting, and valuation discounts to minimize tax exposure. For estates above exemption thresholds, careful planning is essential to manage liquidity and tax liabilities. This helps avoid forced asset sales. The permanency of exemption amounts reduces the risk of unexpected tax bills but requires ongoing monitoring of legislative developments. The debate around estate tax reform balances the goals of economic growth and family business preservation against concerns about tax fairness and revenue needs. Understanding these arguments is vital for effective estate planning that aligns with current laws and anticipates possible future changes.